Good morning, everybody. I am coming to you early because it is a crazy busy day, a crazy busy week, and I want to keep you updated on what the heck is going on. I got not one, not two, not three, not four, but 5 different people in the last 24 hours saying, John, are you going to talk about what happened with the Fed? Well, there's more to this story. And so I wanted to put it to this morning because I do my live stream every single week. Secondly, is I really wanted to have the rest of the story to give you a more complete outline of what the heck is going on. So let's go ahead and I'm going to pull up a little bit of information here and we're going to update you. So first of all, this is my weekly market update for August 2nd of 2024. We have it's 5 months left in the year. So the year is passing us by. So here's the big question. Did the floor just fall out of interest rates? And that is really a critical question for us to explore is what the heck is going on with the Fed? And what did the Fed say this week? What does it mean to interest rates and where are things going? And so let's just talk first and foremost about what the Fed said this week. The Fed made it pretty darn clear they are going to drop interest rates in September. Now, the Fed can't be seen as wavering. They can't be seen as saying, yes, I'm going to do one thing and then end up changing their mind and doing something else. They have to telegraph what they're going to do. And Wednesday was the final piece of the puzzle where the Fed telegraphed, we are lowering interest rates in September. Now, if we rewind back to January, December of last year, and everybody thought the Fed said, we're going to lower interest rates 6 times during the month of, during 2024. And we've had 0 rate drops. And we're now 7 months into the year. We're going to be 8 months into the year with 0 rate drops. There's only 3 more Fed meetings, September, November, and December. How in the heck are we going to have 5 or 6 rate drops? Because the Fed may very well drop rates twice in each of those meetings. So it has to do with how the Fed balances the 2 things that they're in charge of. So the first thing that the Fed is in charge of, it's called a dual mandate. The first thing is they have to keep maximum employment, the most number of people employed that want to have jobs. The second thing the Fed is in charge of is stable prices or keeping inflation in check. A little bit of inflation is good, but the Fed's job is to keep inflation in check. Okay, so the Fed has basically been ignoring unemployment for the last 2 years because inflation has been the major problem. And so it's like, hey, this one over here is not a big deal. Inflation is the major problem. Now we're seeing things change. Let me show you something here. So this is a couple of charts that I want you to understand how they impact what's going on. So the Fed, again, said clearly, we are going to be lowering interest rates. They didn't say they're going to lower rates, like they won't promise it, but they clearly are lowering interest rates, and they did everything they possibly could short of saying we guarantee it. Because again, they have to be open to what if interest rates don't go down, or what if inflation becomes a bigger issue again, and they need to keep interest rates where they're at. But here's what I want you to see. Hold on a second. Let me make this easier. Get rid of that. Zoom this guy in. So this service that I subscribe to that provides this news, and they basically wrote this article saying, hey, this might be the week that we look back at that says it changed everything. Okay, there have been multiple moments in time when just everything changed and the direction shifted. So we saw last year the direction shifted when the Fed finally said we're done raising interest rates. And so the concern was rates are going up. The Fed said, we're done raising interest rates. The market now leveled off and interest rates started trickling back down. So we hit a high in interest rates last year in October, and we were pushing 8.5%. We're now in the mid 6s. And in some cases, we're tickling 5. That is crazy how quickly things are moving. The question is, how quickly are they going to move from here? So it is pretty clear the Fed has said we're open to doing multiple cuts before the end of the year. So now we add this morning's jobs report. Now, again, 2 things the Fed's in charge of: controlling inflation, keeping it low, and keeping employment high. And what you see is the jobs numbers are declining. We're seeing the jobs numbers going back to 2022 that were super high, and then there's peaks and valleys and peaks and valleys, but you notice they keep going down. We're at the lowest number right now, and they actually revised last month's numbers down even lower. That means the Fed has to pay attention to jobs. And to get job creation, they lower interest rates. Because when you lower interest rates, people buy houses. And when people buy houses, then realtors make money and title companies make money. And they need to hire people. And so all of that creates more jobs. So lowering interest rates also entices employers, big factories to be built so that they can employ more people because they can borrow money cheap to build the factory. And when the rates are high, they're not borrowing money cheap. They're not going to build the factory. All right, let me make this screen a little different so you can see me a little bit better. How about that? All right, perfect. So what does that mean? It means we've seen unemployment, the number of jobs created drop. So that means that they're worried about employment and the unemployment rate is going up. So we saw the unemployment rate high with COVID. It came down, which meant, hey, we're worried about inflation. We're not worried about unemployment because the unemployment rate's coming down. It's shooting back up, and it's shooting back up pretty quickly, and that is scaring the heck out of the Fed. And then we've got what's happening with the 10-year Treasury. So the 10-year Treasury is the best indicator of where mortgage rates are going. Okay, mortgages are a bond, just like the 10-year Treasury note is. And so if you're an investor, you have a choice. I can put my money with the federal government and get a guaranteed return because the chances of the federal government defaulting is pretty slim. Or I can put my money into a mortgage bond, which has a chance of a home buyer not being able to make their payment, and I could lose money. So I better have a higher interest rate than that. And so there's called a margin or a markup. And so when the 10-year Treasury goes down, mortgage rates follow. They're not exactly the same, but they follow very closely behind. So what we saw is on Fed Day, we saw rates drop significantly. And then yesterday, we saw rates drop again with some economic data that came out yesterday that was good news for mortgage rates. And then today, the jobs report comes out, and we saw the same thing. 3 significant drops in interest rate. I'm going to take this chart, and this chart is actually showing you the same thing, the 10-year Treasury, but now we're going back to last year, and we're seeing that we hit our peak last year right here. So we were over 5%, and that happened on, I got to zoom down a little bit, that happened right there in October of 2023. And then we saw rates start falling, and they fell pretty quickly right here. And they flattened out a little bit, and they fell pretty quickly. And then they flattened, and they fell, and then they flattened, and then they fell. And so they went down here, which is exactly where we are today. We're starting now at a lower level. We're not as high as we were. We're starting at a lower level. But this is a very sharp drop. It reminds us of what happened here. It reminds us of what happened here. The question is, are we going to have a repeat of this? Are we going to have a repeat of where, hey, it dropped real quick, and then it came right back up? I believe the answer is no. We're not going to have a repeat of that, but it creates a lot of unknowns. Everybody is saying, okay, John, I get it. By the way, let me go back here and finish this out, which is, what's the Fed going to do? And everybody says, I'm going to wait until the Fed lowers rates in September. Okay, do not wait for what the Fed does, because they're telling us ahead of time what they're going to do. So rates are falling right now because of the Fed saying, hey, we're going to lower interest rates, and then economic data that is agreeing with the fact that they're going to lower interest rates, and the jobs report that's agreeing that they're going to lower interest rates. And so the market is already betting. They're literally betting what the Fed rate is going to be at the end of the year. That's this last chart. So up until really middle of July, the Fed, we were thinking, hey, the rates may be 0.25% lower by the end of the year. They're 5.5 right now. They figure 5.5. They're 5.25, 5.25 to 5.5. So they're 5.25 right now, and they're saying, hey, we think. I'm sorry, this is 0.5%. Yes. So they're 5.5. We think they're going to drop to around 5%. So we're going to see maybe 2 rate drops between now and the end of the year. That's what we were planning on 2 weeks ago. And then we end up on Fed Day, and we say, oh, really since the middle of July, we're like, we think there might be 3 rate drops, okay, before the end of the year. And then yesterday, it dropped significantly. They went from 3 rate drops to 4, and they're actually tickling right now that the market is planning for 5 rate drops. Now think about this. The market right now is planning for 5 rate drops. So if those 5 rate drops happen, rates stay the same as they are right now, because rates are already dropping because the market is planning for 5 rate drops. Do not wait for the rate to drop, because it's already built into the numbers. We saw that drop yesterday, Wednesday, and today we're seeing rates drop, and we're seeing rates drop because the market is now planning for 4 to 5 rate drops before the end of the year. So if you wait for the rate to drop and it drops the exact amount we expected, you're not going to see a better interest rate. It's already here. If you say, you know what, John, I think the Fed's actually going to announce even more rate drops during their September meeting, that will cause interest rates to go down more, because rates react to what the Fed projects that they're going to do, not when they actually did it. So remember this moment. When you talk to me in September and you say, John, the Fed's going to lower interest rates next week, I'm going to wait next week to lock in my interest rate. You're not waiting for the Fed to lower rates. Rates have already fallen with the expectation that the Fed is going to do that. The only thing that bad can happen is that the Fed says, we decided not to lower interest rates. Well, now we got a problem. Now rates are going to jump up after the Fed meets because the Fed didn't do what we expected them to do. Otherwise, we are 100% expecting the Fed to lower interest rates. And so now the question is, do we think the Fed is going to announce even bigger rate cuts at any of their upcoming meetings? If they do, at that moment, rates will fall again, just like they are. Now, you're going to say, John, see, the Fed lowered rates and that caused mortgage rates to fall. That's not true. The Fed told us they're going to do even more rate cuts in the future. That's what will cause rates to fall, not the Fed actually lowering the interest rates. Everybody misunderstands it. Rates are falling right now because of this, because of the Fed funds rate expectation. What do we think the Fed's going to do? And we are lowering interest rates right now in response to that. So for my dreamers, the people who are doing California Dream for All, we've been tracking this regularly, and you can see CalHFA has been dropping its interest rates pretty significantly. And so if we look here at CalHFA's interest rates, and it's an easy way for us to track the direction of interest rates. So CalHFA, the Dream for All program, is now at 6.375. The lowest had been 6.5%. Really, we've been tickling 6.6 to 6.875. We're now down to 6.375. An FHA loan with CalHFA is 6.125. Okay, it was 6.25 yesterday. We're getting lower than we've seen, and I think it can get even lower. I think that what we're going to see, if we look back at this chart, is you see the numbers drop and you have a little bit of a bump, and then they drop and then a bump and then they drop. And so it isn't until you see a lot of flattening that you know that they're done falling. So the question is, when do you lock? That is the hardest question to answer because there isn't an answer. There's no easy way to know when is the right time to lock your interest rate. What you have to do is you have to, first of all, trust the person that you're working with. That's me. The second thing that you have to do is you have to figure out what is my risk and how much time do I have to risk it? Because if you think about the chart that I was just showing you, when rates are moving, even though they're moving down, they're bumping in between. And so if you end up that you're in a position, let me share the screen again. Let's go back to here. You end up and you're in this position where you're like, hey, I'm seeing interest rates come down. Let's use this example right here. So just recently, right here. So we're at May 29th, and we see interest rates drop, and then they bounce up some, and then they drop, and then they bounce up, and then they bounce. Oop, they bounced up a lot. So what if you were right here on this date, June 11th, and you only have 5 more days to lock your interest rate, because you have to lock typically about 10 days before you get your keys. And so you have 5 more days to lock your interest rate. You're like, oh man, they're going down and they've been dropping and dropping. And so I'm going to keep waiting. And now you wait your 5 days and rates end up right here. And you lost, because in the short term, rates move a lot. You see it all the time. Even as rates are going up, you see them go up and then drop some, and then up and then drop some. And so you have to be worried about the short-term volatility. You cannot time the purchase of a home to match the interest rates perfectly, especially when it comes to the amount of homes for sale versus the number of people shopping for the homes. Because there are a lot of people right now who are saying, hey, you know what? I want to wait for rates to drop. There's people who are literally shopping right now. They're saying, I'm putting the freeze on it because I don't want to buy right before rates drop. That's fine. But what you created is a buying opportunity for everybody else. You created a buying opportunity for the people that are willing to pull the trigger. Because guess what? You were willing to buy a house a month ago when rates were higher. But because you're seeing it go down, you get greedy. You say, oh my gosh, I can get a little bit more. I can get a little bit better interest rate. And so I'm going to do that. I'm going to wait for that interest rate to drop. And it may pay off. While you're in escrow, it may pay off. But for other people, they're saying, I'm not going to be in escrow. I'm not even going to buy because I could have bought. Good thing I didn't buy a month ago when rates were at 6.9 or 7. But I'm seeing they're getting at 6.5 and 6.3. And I'm going to wait until they get down to 5. But when they get down to 5, everybody else is starting to buy now. and you don't have as much inventory, and you have more competition with other people, and you end up paying more for the house. So be careful. Take the win. Right now is the perfect time where you can take the win, get a house, get a little bit better interest rate than you were expecting, and bind the house and have the seller that is likely willing to negotiate. I am hearing from so many realtors saying it's dead right now. Buyers aren't buying because either they are waiting for the rates to drop or they're waiting for the election. There are so many reasons to wait right now, but none of them are really going to change the big picture of what you're trying to accomplish. None of them are going to put you in a position that says, oh my gosh, it changed everything for me by waiting until after the election. I don't care who wins the election. Now, I care. I'm not going to tell you who I care to win. I'm just telling you from a rate home buying perspective, elections happen every 4 years for presidential elections. The world continues. Life goes on. Okay, it happens. I don't care who wins in November. We're going to continue to buy and sell homes. Interest rates are going to continue to go up and down. And the Fed clearly has kept interest rates too high, too long, and they're going to drop it. I don't care who is elected in November. Rates are going down. I don't care who is elected in November. The people who have been sitting on the sidelines are going to jump in and start buying homes, especially next spring. Now, I think you have a great window of time right now, especially before September. And those of you who have Dream for All vouchers, you have a very limited amount of time. You are specifically sitting on a ticking time bomb that many of you have less than 60 days remaining. Trying to time this is horrible. Your ability to time this is not going to exist. So be happy with the rate that you've got and don't look back. And that brings me to my next question, which is, what if I already locked an interest rate? John, I'm working with you. I'm working with somebody else. I found the right house. Whether you are a Dream for All person or not a Dream for All person, if you're a Dream for All person and you've locked your interest rate, you don't have an option unless you cancel the home that you're buying. That is a huge risk, especially 4 or 5 weeks into your voucher that you have 12 weeks to use. And you say, I'm going to cancel this house because I want to save a little bit of money off of my interest rate. You may pay a whole lot more for the house. You may end up in a position where you can't find the house in the neighborhood that you're looking for. You may end up in a position that you waited too long and you don't get your voucher. So you have to decide, do I take the bird in the hand that I have right now, or do I let it go, hoping to get something better? You don't know where rates are going to go in the meantime. We started at 7.125 a month ago for Dream for All loans. We dropped down to 6.625, then back up to 6.875, then up to 7.125. So the people who hit 6.6 and didn't lock because they're like, hey, they're moving down, they're regretting it because it moved up to 7.1 again. Now I got people who locked at 6.8. They're saying, John, I want out of my lock. The only way out of your lock with the Dream for All loan is for you to cancel that purchase. Okay. Now, if you didn't use Dream for All and you're doing a traditional loan and you've locked your interest rate, if it's any kind of down payment assistance loan, the rates are controlled by the down payment assistance entity, and they don't allow rate negotiations or breaking of a rate lock. If you are using a traditional loan with a traditional lender, FHA or conventional, here's the deal. Lenders I don't know of any lenders that allow a float down. I don't know any lenders that say, oh my gosh, no matter what interest rates do, if they go up, you're covered. If they go down, you get the lower interest rate. I know of nobody offers a float down. But a lot of us understand, everybody understands that technically you can switch lenders. You can. Now, do you want to switch ponies in the middle of the race? What's the risk versus reward in starting over with somebody else? So the bank says, look, if rates have dropped a whole lot, then, and by the way, we're not making money. If rates drop a lot and we keep your interest rate, we've already hedged that loan, okay? Which means that we bought an insurance policy against rates going up. And so if rates go up, we lose money on the rate lock, but we make money on the hedge and it balances each other out. If rates go down, we make money on the rate lock, but we lose money on the hedge. They balance each other out. When you locked, we bought an insurance policy against interest rates changing, and we are not winning if rates drop, but we lose if you cancel. And so oftentimes we'll do some form of a concession. Hey, we'll drop your rate by 0.1% compared to what you locked. This is not when you're using down payment assistance, but when you're using a regular loan. Most banks have some form of concession, some form of, hey, let's help you out and make it a little bit better. But the truth is we're losing money to do it. We're just trying to keep you happy as a client. But there is no circumstances in which you can just plain get the current interest rate once you've locked. because every bank hedges or buys an insurance policy against rates changing. So your ability to call the bank and saying, hey, you're making a whole bunch of extra money because interest rates have dropped, you should pass that along to me, isn't true, because we bought the insurance policy against interest rates going up. All right, we got some questions. Hey, I think I knew. What's up with you too? All right, what is the current FHA without points right now? That's actually a great question, and it's impossible to answer. So I am going to, where did I had this somewhere? Right here. How do I know what today's rate actually is? There is no such thing. Literally no such thing as today's interest rate, which is really what you're asking. What is today's rate without points? You don't know. Because it's kind of like saying, what is gas prices right now for premium unleaded gas? I don't know. Depends on what gas station you're buying at. Depends on whether it's Chevron with Techron. Depends on whether you're paying a 50-cent fee or a $1 fee to use their ATM versus, and they'll give you a lower price on it, but they make it a discount because you use the ATM. It depends on whether you're at the gas station next to the freeway or whether you're at the gas station in the middle of nowhere where there's no competition. All of those things, there's no such thing as today's gas price. And there is no such thing as today's interest rate, because you have really three components that add up to the interest rate, and then a fourth variable. So the three components are, what's the market doing? That's like for gas, that's like, what's a barrel of oil cost? Because what a barrel of oil costs for me to buy and refine is what my cost is to replace the gas that I'm pumping out of the tanks into your car. So I got to know what the cost of the barrel of oil is. That is what the market is doing. That's what we've been talking about with the 10-year treasury going up and down. That's the market. But on top of the market, you have your risk adjustments. Every single loan, FHA, conventional, every loan has risk adjustments that says, hey, if you have this credit score and this much down payment, your risk is that. So you have that component of it. And then the third component of it is the markup of the institution that you're working with. And that is a real thing. Okay. You can work with an online institution that has zero local presence, that pays for the least expensive employees, that have the least amount of knowledge, and you can cross your fingers and pray that they get you to the finish line. And they have the least amount of markup because they have the lowest overhead. Or you can work with a huge bank that spends a lot of money on advertising, and so you have to pay a higher markup to pay for their advertising, but they still don't pay for the best employees because they have to put their budget towards advertising. Or you can go with a bank like us where we hire the best employees. We have the best process, the best tools to take care of you. There's a cost for that. You're going to pay something similar with us as you're going to pay with a big bank that's spending a whole bunch of money on advertising. The trade-off is you're getting a better service and a better process, but it's not the cheapest out there. There's always somebody out there that's cheaper. So there is no number. It's like Kmart. I know Kmart's gone, but it's like shopping at Kmart versus shopping at Nordstrom's. You get the same pair of Levi jeans at Kmart versus Nordstrom's, but the process of somebody helping you pick out the jeans, the process if you have to return them and how easy it is to return them, all of those things are different. How they take care of you through the process, that they follow up with you every 6 months to check in and make sure that you're happy with your purchase. That's the difference on who you're hiring, and that has to do with that third component, which is the markup. And then the final piece has to do with buying down rates and what a buy down will give you. And so I'm not sure if this analogy or this sharing of this will make more sense or not, but their mortgages are traded in coupons. Okay. So there is, and I'm going to show you this right now. Let's see if I can make this let me make it super big. So let's get rid of this and let's make this right there. Is that still big enough? No, let's probably go bigger. Okay, so these are the coupons. These are saying, hey, there is a 5% coupon. That is what the investor wants to earn, is 5%. And if we sold a loan into that rate, the investor's earning 5% from you every year, but we got to pay them 0.5% because they're like, look, at a 5% interest rate, it is not worth the money that we loaned. Okay, so we'll earn 5%, but we're actually going to lose a little bit of money. So you got to pay us up front. And so you're going to pay us about 0.5%. It's not worth 100%. At a 5.5%, and you're saying, John, rates are at 5 and 5.5. Bear with me, I'll explain it. Okay, at 5.5 coupon, that's what the investor at the end is earning. They're actually paying 1% back to us as part of our revenue. So a bank is earning, well, 0.8%. And at 6%, we're earning 1.8%. So what you notice is there's a little bit more than a 1% bump in fee here and almost exactly a 1% bump in fee here. Now, same thing, Ginnie Mae is your FHA. So they're, again, pretty similar. But then there's markups on that because that's what the investor wants to earn. So that's kind of what the step one is. But I forgot to talk about servicing, which is the person who is actually collecting your monthly payment. There's a markup to the interest rate for them. There's a markup to the interest rate that pays for your risk. There's a markup to the interest rate that pays for the profit to the bank. So we're not adding a whole bunch extra in fees. We're adding it to the interest rate, and then you can pay the fees to buy it back down. So the bottom line is, and I'm trying to simply answer the question, and there is no simple answer. How do we know what today's interest rate is? You don't. There isn't a way to know today's interest rate. You have a rough idea. So you can check websites and CalHalf is a good example of watching trends. What you're watching is trends, and rates don't move down evenly. So the market will hit fits and starts, and we might see the market come down some, but a bank might not lower the rates that same day. They might have too much business, especially because we're potentially heading into a refi market. And so a bank says, I've got too much business. I've got to slow it down. And so the market may come down, but the bank says, I have to throttle back. I have to slow down how much business I have coming in the door. So I'm going to not lower interest rates. Okay. That's where the market, if it starts falling too quickly, banks will not follow suit because we don't have enough staff. We've lowered our staff significantly over the last 3 years, and we cannot afford to do that many loans because we would never get them done. Unless you're one of the unscrupulous lenders out there. And actually, I'm already hearing about it. And I want you to be careful. I want to warn you because there are lenders out there who are going to call you and say, hey, I can refinance you and I can get you a rate of 5.25%. You're like, that's crazy. John King just said rates aren't there yet. They're in the low to mid sixes still. They're like, no, I got a program I can get you there. It's probably going to take about 90 days to get the loan done, but let's get you started. And they send you disclosures that say 5.25. But in the top right corner of the loan estimate, it says not locked. They hope you don't pay attention to that because they didn't lock the interest rate. Then they collect your income docs. Then they make you pay for a credit report. And then they tell you, hey, there's been a little bit of a delay in processing. And so, we got a lot of people. This is an amazing program. We got a lot of people who are interested in it. So 90 days is probably now going to be 120 days. They're buying time waiting for rates to drop so they can lock you in. They are lying to you and saying, oh, we got you this interest rate. Because what's the worst thing that's going to happen? Rates never go down to where they want. They keep dragging you along, and then finally you quit and say, forget it, I'm going somewhere else. And then you call me and I tell you the truth, which is rates were never that low, and they just wasted your time, and they wasted your money on the appraisal fee. So don't believe the guy who is selling the bag of beans that tells you it's going to turn into a beanstalk. It might at some point turn into a beanstalk, but he's telling you you're getting it today, and he's lying to you. So be very, very careful because as rates start falling, you're going to hear all the sharks coming out of the woodwork. Okay, you're going to hear them coming out and telling you things that sound too good to be true. And if that sounds too good to be true, it probably is. So let's recap a couple of things. Should you stop shopping until the Fed drops rates in September? No. Should you stop shopping until the Fed, until the election? No. You have to know, can I afford the payment today? And you are going to say, but John, I can afford it better tomorrow if interest rates fall. Or I can afford a higher priced home tomorrow if interest rates fall. But the home you're buying today, when interest rates fall, will be that same higher priced home, and you missed out on that equity. Don't make that mistake, okay? There is no timing the market. It's about time in the market. So the Fed is going to be lowering interest rates. I am convinced that the Fed is going to be lowering interest rates. I'm convinced that the Fed is going to start lowering interest rates in September, and I am convinced that the Fed is regularly going to lower interest rates at every meeting, probably for the next year and a half. Okay, that's probably going to put us somewhere. My hope is we're going to land somewhere in the 4% range for mortgages. But the question is, what's it going to look like in the meantime? And are you going to wait and hope you see something better on the other side, or take advantage of the market opportunity right now? And for those of you who are homeowners, the question becomes, what about refinancing? And the biggest key is, what are your needs today? Because, hey, as a homeowner, if you wait, you already own a home, you can get a lower interest rate. So there's no need to jump on it immediately. We're not there yet. When that person calls you and tells you it is time to refinance, look at your own personal numbers. Call me, please. Let me talk you through it and figure out whether it makes sense or not. Don't jump just because rates are a little bit lower, because you're paying fees when you refinance. And if they tell you there's no fees, they're charging you a higher interest rate than you could have gotten if you paid fees. There is no such thing as a free lunch. So be aware of that fact. Be educated. Check out my website, canirefi.com. I've got, yes, canirefi.com. That's me. So if you have questions about refinancing, go to canirefi.com. Take a look around. Fill out my form for us to reach out to you and run numbers for you. We are not going to push you to do a loan until it makes sense. Okay, so allow me to guide you, because we are headed into a new market. We're heading into lower interest rates. We've been waiting for this. We are here. So now is the time to be careful about the decisions you're making and make sure you're getting the absolute right advice. And do not listen to the person holding the bag of beans saying, this is better than what everybody else has to offer, and I'm the only one that has it. If it sounds too good to be true, it probably is. All right, guys, if you have any questions, please always reach out, ask me questions. Whether you're watching live right now and you have a question, feel free to post it. If you're watching recorded, post the questions and I will follow up with those later. But just know, volatility is going to get even stronger going here on out, and change is around us. Okay, we have a lot of changes happening right now with the National Association of Realtors and local realtor associations in the state of California and other states changing how you buy and sell homes. In the end, it's shifting the negotiations. Okay, and I'm going to spend a lot of time. Hopefully, I'm trying to schedule it probably next week on Friday night. I'm hoping I can do a live stream that talks all about what's happening with all of the changes in real estate. But I want you to understand, ultimately, everything is going to be similar in that you can negotiate to have the seller pay for your real estate agent's fees. But it's going to be very, very different, the process. And there are going to be times in a very hot market that you're not going to be able to have the agent's fees paid for by the seller. Just like people who needed seller credits to pay their closing costs couldn't get that in a super hot market. The market is shifting, changes around. Not only do we have shifting in interest rates, that's going to lead to shifting in house prices. And we have the shift right now in how you go about buying and selling homes and how you negotiate with your real estate agent. So please stay tuned. If you know anybody who could use this information, please share this with them, get them to subscribe, click the like button, all those things that I'm supposed to tell you to do. Thank you so much for listening. I hope everybody has an absolutely wonderful weekend. And thank you for trusting me to guide you. If you do want to set up a one-on-one, download my mobile app. There's a button on there that says schedule a consultation. I look forward to taking great care of you. Everybody have a great weekend. Bye-bye.